The Fed's expected to hike rates by 75 basis points today, and Jeff Gundlach says that bonds are now cheap relative to stocks. That's coming up on 3 Minutes on Markets and Money. The Fed widely expected today to hike rates by 75 basis points. All eyes will be not on the rate hike, but on the statement. Does he reiterate his more hawkish claims from Jackson Hole, or does he back off that pedal a little bit? That's going to be the big issue that drives markets later on this afternoon. Of course, they're also going to release their projections for the economy, for inflation, for consumption. We'll also get those projections as well. What are they looking at? Is a recession on the rise? Those are going to be all the questions that are going to be coming out of today's FOMC meeting. And of course, the markets will be dealing with that. But interestingly enough, the Fed does control the short end of the curve in terms of rates. And right now, as the Fed is hiking rates, we're seeing the 3-month and 2-year Treasury rates now reflecting that much higher end rate, potentially, of where the Fed is heading to. 2-year Treasury trading pretty much at the terminal rate of 4 to 4.25%. Jeff Gundlach out yesterday saying bonds are cheap relative to stocks. And that's something we haven't heard him say here in a while. And he's right. The last time that we saw interest rates really kind of rising to these levels was back in 2018, 2019. Of course, this was just prior to the entire shutdown of the economy. And of course, right there at the peak of the market in 2019 was where the Fed was starting to do reverse repo as the hedge fund world in general got into some financial trouble, needed bailouts. But that was the beginning of the end in terms of rate hikes and rate increases, at that point on the longer end of the curve. Prior to that, we go back to 2015, 2016. That was where we had Brexit. And then prior to that, go back to the 2009, peak in the market again. When rates reach exceptionally high levels, that's where the impact to the economy is going to lead to a recession, an economic event, or potentially a credit-related event. And so that's why when rates get up to these levels, that's why these typically tend to be really good buying opportunities for fixed income and longer duration bonds in portfolios as a hedge against stocks. Because as we start to get into a more recessionary environment in the economy, earnings begin to slow, stock prices are going to have to reevaluate that. That leads to a shift from risk assets, i.e. stocks, into bonds, which, as Jeff Gundlach states, are relatively cheap relative to the stock market itself. That's 3 Minutes on Markets and Money. See you back here tomorrow.